Diversification is a hedge for ignorance. You diversify because you don't know the future. This quote is by Ray Dalio, the founder of one of the world's largest hedge funds, Bridgewater Associates, who made his fortune diversifying the right way. And in this video, we're going to learn how to accomplish the same things Ray Dalio did, at least from a diversification standpoint. And at the end of the video, I'm going to be sharing with you the diversification rule that I learned from Ray Dalio so that you can apply that to your own portfolio and therefore become a better investor. So let's get started. But before we do, please don't forget to like and subscribe to the channel because obviously it really helps me out and you'll have more access to content like this. All right, another quote that I wrote down from Ray Dalio in one of his recent interviews is, "Diversifying well is more important than almost anything else." When I heard this, it led me to wonder what he meant by diversifying well. And in my research, I realized that I really had no idea what that actually meant. For example, let's say our friend John Doe owns stock in technology, financials, utilities, commodities, and consumer staples. The question is he diversified? And after my research, I would say that the answer to the question is no, because he's only representing one asset class in his overall portfolio. And although the stocks in this portfolio would normally have a low correlation to one another in a normal market environment, if there was a major risk-off event like a pandemic, then all correlations would go to one and this entire portfolio would take a major hit. And if he was only holding stocks in these sectors, he could be missing massive rallies in other sectors, such as bond markets and currency markets. And this is in a nutshell why diversification is so important, because we can never know for sure what sectors or industries or markets are going to move the most at any given time. So it's really good to always have your money spread out, basically. This will not only give you more opportunity to recycle winning positions into potentially promising positions, but also insulate you from black swan events like we experienced in 2020. So to diversify well, you really need to understand the major asset classes that you have to invest in. Those are cash, stocks, and bonds, both foreign and domestic, foreign currencies, real estate, cryptocurrencies, commodities, and collectibles. But within these major categories, there's also subsectors that you can invest in. So for example, in real estate, you have residential real estate and commercial real estate. In stocks, you have technology and commodities. In bonds, you have short dated, long dated, and you get the point. And the reason I bring this up is because when we talk about diversification, we need to understand the major asset categories that we have our money into, but also the subcategories within that category that build our overall portfolio. And in the end, the key to overall financial diversification is to build a portfolio with major asset class diversity, as well as stock portfolio diversity. This means holding cash, precious metals, extra food, collectibles, and real estate, and also a diversified stock and bond portfolio. And as far as stock and bond diversification goes, the key is to hold a mix of assets that basically dampen the effect of normal market movement on your portfolio. And basically you do this by holding several different uncorrelated investment positions, both on the long side and on the short side. All right, now let's break down an example of an optimally diversified portfolio so you understand what I mean. First, again, let's review our major asset classes, which are cash, stocks, and bonds, both foreign and domestic, foreign currencies, cryptocurrencies, real estate, and collectibles. For this example, we're going to build a diversified portfolio for John Doe with a liquid net worth of roughly $150,000, who, like most of us, is not a currency trader or a collector. And let's assume he doesn't own any real estate. So for this example, let's ignore real estate, collectibles, and foreign currencies in our total portfolio. So first things first, let's assume John Doe has monthly expenses of roughly $5,000. Now, a basic rule of thumb that I think everyone should follow is to try to have at least 6 months worth of cash on reserves in case of an emergency. So therefore, John Doe would need to put away $30,000. Let's also say that John Doe is a fan of physical precious metals like I am, and he wants to stock away about 10% of his liquid net worth into physical precious metals. So that would mean we'd put $15,000 of the $150,000 into physical gold and silver. Maybe he also lives out in the country and wants to be prepared for some kind of natural disaster, so he also has $5,000 in food and other consumables in his basement for safekeeping. So after deducting the $30,000 in cash savings, $15,000 for physical precious metals, and $5,000 for food and other consumables, we're left with $100,000 to invest in stocks and bonds. So now, let's build his book. Bringing Ray Dalio back onto the scene, his diversification guideline is well depicted in this graph. In plain English, the goal is to hold 10 or more perfectly uncorrelated investments because statistically, the more uncorrelated your portfolio, the lower your annual portfolio fluctuation will be and the higher your return to risk ratio will be. Furthermore, as this graph shows, if your portfolio is perfectly uncorrelated and you have 10 investments, you will almost always, meaning 80% of the time, make money in any given year. So one question could be, why not have more investments? Simply put, and in my experience, it's just hard to find 10 perfectly uncorrelated investments that also offer a pretty solid risk to return ratio. So that's why I try to stick to 10. You can go more than that. You can even go a little bit less, but I wouldn't go below 8. All right, now let's say that John Doe invests $10,000 of his $100,000 into 10 different positions. Let's say on the long side, he owns US government bonds, gold miners, consumer staples, natural gas, dry bulk shipping, biotech, and the Indian stock market ETF. And let's say on the short side, he's sold short the International Bond Fund, big cap tech via the QQQ, and home builders. I would say that in most market conditions, this is a pretty well-diversified portfolio, but for those positions that are more correlated to one another, what I actually did was create parity trades so that I'm long one of the correlated sides and then short the other leg. For example, I'm long US bonds, which historically has been very correlated to big cap tech, but I'm short big cap tech. Finally, this portfolio does a good job representing different sectors that thrive in different market environments. This helps to ensure that at least some of my money is in the right position when the market environment inevitably changes. And as we all know, it's very hard to predict and time market movements, which is why diversification is such a good strategy overall. I would say really the main issue is that it's highly leveraged into stocks. Were this John Doe's real portfolio, his net worth would be essentially 50% exposed to stocks. Granted, he has some short positions that balance his risk, but it's still potentially concerning for someone looking for more safety and perhaps additional income. And if you're the type of person that's looking for less volatility and more income, consider Ray Dalio's all-weather portfolio. In this portfolio, he basically recommends 30% stocks, 40% bonds, 15% international bonds, 7.5% commodities, and 7.5% gold. For a risk-averse person, I would say that this is a pretty good overall strategy, although the macro environment, I would say, is a little bit more hostile to bonds. So perhaps you would unweight bonds a little bit just to be safe. But regardless of your positional weighting in stocks versus bonds, it really does help to develop a little bit of skill in technical analysis so that you can time when you take positions more effectively. And if you need more help in this area, don't forget to subscribe to my channel and check in the link down below for access to my Discord channel. I hope to see you there, and I'll see you on the next video.